Welcome to Market Overtime. I'm Nicole Petallides. The Federal Reserve has delivered its first rate cut of the year, a widely expected 25 basis points cut that had broad support. On this episode, we'll examine the FOMC announcement, Jerome Powell's commentary, and what this all means for your portfolio, as well as investigate AI. Of course, we've had so much momentum with AI, but when does it fizzle out? When do some of the details within AI and fundamentals really matter? And we bring in an expert for that tech talk part of the story as well. It is my great pleasure to bring you Dan Niles, the founder of Niles Investment Management. Dan, it's great to see you. I'm so glad you are with us to talk everything from Fed, economy, tech, and more. Let's start with the Fed meeting yesterday, the 25 basis point cut, which is what Wall Street anticipated. What were your initial reactions to some of the comments that were made by Jay Powell and the cut itself?
Well, I think the interesting part was you look at the dot plot. So what did the Fed do? If you look at how that changed from 3 months ago, you added one rate cut to this year, 2026 and 2027. But if you look at the forecasts underneath that, they edged up the GDP forecasts, they edged up the inflation forecasts, which is the most important thing, and then they edged down the unemployment rate over those 3 periods of time. So you have to sit there and ask yourself, wait a minute, you're increasing the number of cuts, but you're also increasing the expectations for inflation. So what that tells you is they're going to let the market run hot, and that's just going to continue to fuel stocks going higher because of that. And the way to think about that is like in 2021. If you remember, CPI started the year at 1.4%. It ended the year at 7%. The Fed kept saying it was transitory, so left rates at 0, and the S&P finished the year up 27%. So that's why we've been saying for the last several months, we think the market's just going to melt up because the Fed's going to probably cut 3 times, and much like you saw in 2021, the market's just going to want to go higher.
Yeah, you had said that. I saw over the summer you were saying that the market would melt up. And look, we've just been hitting one record after another. We've hit records on the S&P, NASDAQ, and Dow very recently. And then you said that that melt up would continue maybe into Thanksgiving. And what changes?
Well, that's the interesting part. So as we get closer to that time period, the thing I've been watching is if you think about what tariffs did, everybody tried to get in front of tariffs by buying in advance. So the best measure of that is you can look at within GDP in Q1, US imports were up 38% year over year, which is massive. Now, the good news is in Q2, you had that GDP, the imports portion of it, go down 30% year over year. So you go, okay, the good news is some of that got burned off, but there's probably more that needs to get burned off by the time we get to Thanksgiving, because if you think about that period of November and December, for a lot of electronics companies in particular, which obviously matter to the tech universe, they'll do 30 to 35% of revenues just in those 2 months. And 15% of that is just jammed into 5 days between Thanksgiving and Cyber Monday. And so if there has been a massive pull forward in demand, what you're going to see is if you bought an iPhone, a car, what have you, a PC, high-priced items that you were worried about prices going up on, you're not going to need to buy one of those during the holiday period where these retailers are counting on that kind of demand. So that's why I'm watching and monitoring. Maybe we get through Q3 and we burn some more of that, import surge that we saw off, in which case you get through there fine. But that's the next break point that I'm looking for to see how the data evolves.
And just quickly with the market reactions that we saw, for example, I'll note that right before the announcement, we were at 4.05% on the 10-year bond yield. After it was announced, we dropped below 4, and then the next morning at 4.10, and which was higher than where we were initially before even the announcement. Everybody's watching the long end of the curve. What do you make of the market reaction? Did you find that there have been some mixed signals, and why is that important?
Well, I mean, I wrote something up on that this morning, and what I said was that, this is great for stocks, but it's bad for bonds. Because if you use the 2021 analogy, you had stocks going up, but you had bonds selling off. And so I think you look at this and you say, does it make any sense when the Fed has just told you by their own dot plots that they're going to let inflation run hotter while at the same time increasing the number of rate cuts? To me, that's the thing that, much like in 2021 when bonds sold off while stocks went up, I think you're going to see a repeat of that.
What do you think is the bigger problem? I mean, we noted that GDP, the projections from the Fed were higher, right? So that's better for our economy. That unemployment rate comes down. That's also good news in the big picture. Inflation, we're not really sure how the tariffs may. Is it going to be a one-time price increase? What do you worry about most in order? Is it labor over inflation, or what are some of the biggest worries you have? I mean, what's the number one worry when it comes to Fed policy here?
The number one worry is the Fed's back to using this transitory phrase. And that did not work out so well the first time. If you remember in 2021, they kept calling inflation transitory. You look at anything I was saying, I'm like, there's no chance this is transitory with twice as many job openings as people unemployed. And as it turns out, we had the worst inflation in 40 years. So now they're using that word again and saying, oh, this is a one-time step up in prices. But if you look at what companies are doing, that's not the way this is working. They're slowly increasing prices because they know in this political environment, it's suicide to go ahead and make a big price increase all at once. And so it's slowly trickling through. And so what I think you're going to see is that this isn't a big step up. It's going to be a gradual step up over, many quarters as companies have only two choices, right? Somebody has to eat the tariffs. So either they eat it, at which point their earnings go down, their stocks get hit, or they try to pass that on to the ultimate consumer, but they have to do it gradually so not to cause political headaches for themselves. And so that's what you've heard all of these companies in general doing, is they're slowly feeding these tariffs through in terms of prices. So that to me is the biggest concern, is the Fed missing this yet again and inflation staying persistent. But here's the thing. The Fed ignored inflation for a whole year in 2021. So Jay Powell's term ends in May. Can he ignore inflation through that period of time? Yeah, he could. And just say, look, the tariffs happened. We had all this disruption in April, and so March, April. And so, it's been a full year, and now let's see what happens. And then it's another Fed governor's, another chairman's job in May when they take over to deal with whatever the fallout is. So I think that's how this is going to play out. I always like to say, investing is about not what you think should happen, but what you think will happen. And what I think will happen is a repeat of 2021. And then you're going to have to deal with 2022 when the market was like, this isn't the fun and games we thought it was, with inflation being transitory. And I think that's what 2026, as you get into that year, could look like a little bit.
So less worried about the labor market and more worried about inflation and having rates and easy money coming back, and then we'll have to deal with that. As you noted, his term is up next May. Do you have a favorite? There's more than 10 contenders right now. Do you have a favorite to lead the Fed going forward, the Federal Open Market Committee?
Oh, absolutely. I mean, how can you not think that Stephen Marin is the favorite? Because he's obviously the person, if you look at the dot plots that came out again, he was number one, he dissented. He wanted a 50 basis point cut. And then if you look at the dot plots, he's got another 100, if you assume it's him, because they don't tell you, but I would assume it's him. He wants another 125 over the next two meetings, which means 50 basis point cut in one of them and 75 basis point cut in the other. If you think about who President Trump's likely to nominate, he wants somebody that's going to cut rates aggressively. How can you not think it's him? There's three other members of the FOMC that are kind of been mentioned as up for the job, but none of them were nearly as aggressive as Stephen was.
Yeah, it was evident. He was the dissenter with the 50 basis points, and as you said, his projections for lower rates are vast. And for example, Waller, went along with the 25 basis points. People thought that by doing so, maybe he lost his ability to get that Fed chair job. That being said, just any policy missteps. I mean, in the end, could this be a policy misstep if they cut too much? Are we worried about the economy afterwards, whether it's recession or stagflation or anything else? Final economy question, and then I want to get to tech.
Yeah, no, I mean, obviously we've seen what happens when you cut too early. Inflation has been above the 2% target for I think 4 years now, if I remember correctly. And we all saw what happened in the 1970s when the Fed cut too early and inflation just kept ratcheting up. So I think you really do have to worry about it. For me, it doesn't really matter. You just have to get the direction right. And so I'm looking at this much like I did coming into this year, which is it was negative to start the year, got bullish in April. And so if you time these things properly, and there are clues always in the market, you can do very well regardless of whether the market's going up or down. And so that's how I try to think about this, which is living through the late 1990s. There were a lot of signs that things were getting overheated, but you wanted to stay invested because, NASDAQ was up, I think, 86%, if I remember correctly, in 1999. Then in the first 2 months and change of 2000, it was up 24%. And then it imploded and went down 78% from peak to trough over 2.5 years in an absolute bludgeoning. But you could make a ton of money in that run higher. And that's just the markets. And you had these individual, risky names go up even more. And so for us, that's what we're focused on right now, is harvesting as much as we can out of the gains probably remaining, because the Fed has told you what they're going to do. They're going to cut. They're going to ignore any sign of inflation and call it transitory, just like they did in 2021. And so in that environment, why would you be anything but bullish?
Understood. And that's why you have your hedge fund and all the clients calling Niles Investment Management, trying to pick your brain with your yesteryear that began in tech. I mean, people know you as the veteran in tech way back when. And so now we spin it here to tech now. I know there's positives and negatives. I'll start with the positive side of things. You've seen these names grow. You've had some top picks. Is Google, Alphabet still your top mega cap pick?
At this point it is, and it became that right after the antitrust remedies case came out. And nobody was anticipating that they could get away with being able to pay to be the default search engine on iPhones. They didn't have to sell any of their ad tech business either. And so at that point, Google becomes unleashed to kind of do what they need to do. And if you look at the technology that Google has, they invented the transformer technology. That's what ChatGPT and OpenAI commercialized. But they're the guys who actually invented it. So, and if you think about what makes an AI model smart, it's data to train on. And Google, with YouTube in particular, has more free data to train on than anybody on the planet. And that's why last Friday, Gemini actually passed ChatGPT on the Apple App Store for free apps, because they had this product called Nano Banana, which you may have heard of, which is a image editing app that just soaring popularity. But the really interesting part is VO3, which is their video creation app. Now that can only produce about 8 seconds of video at a time, but this is the worst it's ever going to be. So where's that going to be a year from now, especially when you're an economy that's driven by a lot of creative juices? If you can do this with AI, it's going to be absolutely amazing, the things you're going to be able to produce and how it's going to enhance productivity for people in the creative economy. And so I look at Google and it's trading at the lowest multiple of all the Magnificent Seven. It's trading at an S&P multiple. And it's probably got the best prospects in AI in the future now that the founders have come back to working in the company for a while now, and they're focused on giving you accurate answers versus just politically correct answers. And that's made the models so much better and more accurate. And I think it's just going to keep getting better for them from here.
So above 250, where does it go? What do you have a target on where you think it should be headed?
I mean, I never have price targets because stocks always
Okay.
go higher than I ever imagined humanly possible.
Okay.
And they also go much lower than I ever imagined humanly possible. But what I would say is on a relative basis, you've got Meta trading at 27 times PE, Google's at 25 times. You've got the other AI stocks trading in the low 30 times multiple. And I go, that to me, I always look at things on a risk adjusted basis, and I go, that gives me a high margin of safety to be bullish on Google. And also, just stepping back from this a little bit, if you think about over the last 3 years since ChatGPT came about, the big fear, which is very valid, is that their search revenues are going to get absolutely crushed as more and more people use these other search tools. And
Right.
paid clicks, which is a good way to measure that, the quarter after ChatGPT came out, it was up 8% year over year. So number of people doing searches. A year after that, it went to, I think it was 5%. And then a year after that, it dropped to plus 2%. And this most recent quarter, everybody, I think for the most part, myself included, figured it was going to go from plus 2 to a negative number. Instead, it actually accelerated to plus 4, which then you think back to, wait a minute, Gemini just became the #1 app on the free app store. And you go, all right, people are using this more. Now, by the way, I am using Gemini as my go-to AI app for my job. And so I know that's changed because it started off, I used ChatGPT, moved to Grok, and now I'm on to Gemini. And I think a lot of people are doing the same thing.
That's very telling, Dan. Thank you for sharing that with me. So I have a lot of questions. I'd love if we could just sort of quickly run through some of the other ideas. As far as AI, you said also Google was your top mega cap pick. You've also had something featured like the cheapest AI stock, the one that actually maybe people don't talk about quite as much that has potential going forward. What stock would that be quickly?
Well, I mean, I don't know if it's the cheapest, but if you look at Amazon, the stock's up about 5% year to date. They had the worst numbers on AI in the sense that their AWS business was flat at 17% growth in the March quarter, as well as in the June quarter, down from 19% growth in December. If you look at Google, their growth in Google Cloud platforms, that actually accelerated by about 4%, I think. And then Azure actually accelerated from 33% growth to 39% growth from March to June. So Amazon was a big disappointment. They're the biggest company in the public cloud environment. But here's the interesting part. They're the host for Anthropic. And Anthropic has become the place that people are using to help code. And so they're using that a lot more than they're using something like a ChatGPT. And so I think what you're going to see is that in the September and December quarter, you may actually see that AWS growth rate starting to pick up again, because what you've seen is Anthropic's revenues really starting to go up quite rapidly as people are adopting it for code.
I wanted to ask you about Apple, NVIDIA, and Cisco. Apple, you noted, and just quickly on these, Apple, you noted it's been a loser in the AI war. NVIDIA, you showed concern about the data center revenue miss and the cash burn that we've been seeing in AI overall. And Cisco was one of your top picks. Can I have a quick thought on each one of those names?
Sure. I think with Apple, I mean, if you want to, this market is valuation insensitive. So if you put that aside, it's been interesting that Apple demand for the new iPhones has been pretty good, which surprised me. But I think if you look at next year, this could be actually the best growth rate Apple's had in a very long time. I mean, if you think about Apple's revenue growth, it's been 3% over the past 3 calendar years. sorry, 5% over the past 3 calendar years cumulatively. So it's been absolutely horrible. But you're going to get a foldable phone next year, and you will get actual AI products next year. So that's interesting. Cisco, if you believe AI's more traffic on the network, that should benefit them, though they're obviously in competition with NVIDIA as well as Broadcom. So, but it's got a teens multiple. So any kind of improvement in that growth rate, you end up with a revaluation in the stock. And then finally on NVIDIA, I'm bullish short term because I think, especially with the deal you just saw today with them investing in Intel, which is obviously something the US government wants to shore up Intel, I think you're going to see them get a license to ship Blackwell chips to China, which they currently don't have. You should get one more last surge in the stock. But I think, to your point, as you look at next year, it really comes down to, are companies getting return on their investment for all of this money that they're spending on CapEx? And there we can talk about, if you want, there's a lot of data points that are saying that, hey, they're not seeing the returns they should, which ultimately leads to lower CapEx.
Right. And look, we're concerned about the cash burn rate on some of these. Are they getting the returns on what they're burning, to your point? How about, we take a look at some of the quantum computing technologies. Those stocks, names like D-Wave and IonQ, have been jumping, and thinking about how the AI development efficiency is increased with quantum names. Are you looking at those names? Do you like those kinds of names quickly?
I mean, in 2021, if you remember, it was the most speculative of stocks that went vertical. And I believe in quantum computing, don't get me wrong, but in this kind of environment, yes, those types of names will do well. I think in the future, that's also, quite honestly, in some ways, a risk to AI, because you can't have it both ways. You can't say quantum computing is going to be a quantum leap in computing power and not go, well, then that means you just need less hardware. So there is some trade-offs, right, between those two things. It's what you saw in the late 1990s, where efficiencies just got so much faster that even though internet traffic doubled in 2001 and 2002, NASDAQ went down 78% because you had overinvested in the period leading up to that. And the cost to produce that internet traffic just fell off a cliff. And you're seeing some of those things starting to occur today.
Right. And then last but not least, the partnerships we've been seeing in technology overall. I feel like we've never seen anything like it. Collaborations, CapEx spending at home, abroad. We've seen the tech leaders even in the UK in the Castle as President Trump was greeted there. I think about the partnerships that we're seeing. I wanted to get your view there. And something like TikTok, for example, will take many names coming together. Should TikTok be saved? And what do you think about these partnerships that are happening? I'm sure you've met all of these CEOs in the C-suites. Do you like what you're seeing?
Yeah, so a lot in that question. So if you think big picture, the companies, you're not going to have 10 AI companies succeed. It's just not going to happen. What happens in technology is it generally coalesces down to 2 or 3 players that end up being dominant in their category. So if you think of e-commerce, who's that? That's Amazon. If you think of social media, well, you're down to really Meta dominating that. If you think it's search, who's that? That's really down to Google. It's not 5 guys. So if you think about AI, it's going to evolve the same way. So who's going to win? Well, TikTok has massive video content that's free for them to train on, or ByteDance, I should say, has TikTok. So they should continue to do well. Google, we talked about. YouTube, they're going to do great in there as well. X, or Twitter, however you want to call it, they have all that data that comes in. And so, those are going to be some of the big winners on the consumer side. On the corporate side, obviously, Oracle, everybody's got databases, S&P 500 companies, and then you got Microsoft with their Office franchise. So they're going to be the 2 strong players in corporate. Anybody that's not in one of those 2 buckets is probably going to have a much larger problem. And that's probably, quite honestly, too many companies, right? I named, 6 or so names in that grouping. And so that's going to just continue to coalesce down further. And then the market's just going to stop being willing to fund these money-losing operations for companies like OpenAI, where they're, slated to spend 115 billion and burn through 115 billion in cash through 2029. I think at some point, a couple of years, maybe next year even, investors are going to go, wait a minute, we're not getting the return on this. And that's exactly what you saw in 2001, 02, where markets dried up. And so things couldn't happen. I think with regards to TikTok, whether it should be saved or not, it's not something I use, but I know a lot of young people love it. And so I think obviously politicians are politicians. They're going to do what appeals to their voter base. And that's how you're having TikTok saved.
And, the fact that there's so many AI companies that you noted, they won't all survive. We heard Sam Altman saying something similar of OpenAI, saying, look, they're not all going to survive. And that's why you see these partnerships, and then you see which ones have the moat, which ones are the big players. So, the question becomes, when we talk about the tech bubble, the boom and bust of tech that you've talked about a few times here, when will we know that the bubble is about to burst? Because you said you're going to ride the wave of the lower rate environment where stocks continue to move higher. When will we know the turn is happening? Because you did note, for example, the data center miss on NVIDIA, and that when you see growth coming in at 56% rather than 100% year over year, or, there's been so much optimism, and when do you become more pragmatic about the considerations for the fundamentals, and the indifference to those fundamentals starts to matter. People will start to pay attention. When do we know, and what do we look for the AI bubble bursting, and when do we take money off the table?
Well, I think you've gotten some signs on it, and so you have to monitor it. Obviously, MIT had that study that came out that said 95% of the corporations investing in AI were seeing 0% returns. Now you can say, well, yeah, but that's a survey, so I'm just going to ignore that. But look at Salesforce. Salesforce stock was sitting at an all-time record high in 2024, and they were the poster child for agentic AI, right? We're going to have these agents that are powered by AI that end up doing all of these things, and corporations are going to love it, and they're going to adopt it. Salesforce stock in August hit a 52-week low because, in general, corporations, much like that MIT study talked about, are finding out is much harder to implement than they ever thought, and the returns are a lot harder to measure than they ever thought. And so that's what's going on underneath all of this. Now, in the near term, the fear for all of these tech companies is if I stop spending and I end up being the Yahoo, right, or to Google, or if I end up being MySpace instead of Meta, or I end up being RIM instead of the iPhone, I'm just killing my future. So these companies right now are all spending aggressively, but the ones that are going to be able to survive this are the ones that have the cash flow. So if you think about it, right, Amazon's got a massive e-commerce business to support the AI spending. Microsoft obviously has their corporate business. You've got Amazon e-commerce. So the guys that actually have the massive cash flows behind them, Meta with their social media, they can ride this. A company like OpenAI or some of the other startups that all they have is the AI business, they don't have a massive cash flow generating business behind them. They're the ones that you have to really worry about when this ultimately people go, yeah, we're spending all this money, but the revenues and the profits aren't coming in the way we thought. And if you look at OpenAI's forecasts, when they revised them just about a few weeks ago, they raised their revenue forecast by $26 billion to $200 billion. But to get there, they increased their cash burn by $80 billion through 2029. So that's already telling you the return from the guy who you could argue pioneered this is not what they thought it was going to be. If your revenues are going up by 26 billion, but you're spending an incremental 80 billion to get there.
All right. Well, you have so much passion for tech, and we know that AI continues to grow, and maybe we'll all have humanoid robots. We're talking to the AI agents. Dan, you've watched it all emerge over the decades, and we really appreciate your perspective as well on what the Federal Open Market Committee is doing and the big picture. Really glad to have you on today, Dan Niles. Thank you so much for being with us. Dan Niles, founder of Niles Investment Management. Thank you.
Thanks, Nicole, for having me on.
Coming up, I'm joined by Danielle DiMartino Booth to discuss if the Fed has made a mistake waiting too long to cut. Also, who will replace Jerome Powell as chair of the Federal Reserve? Welcome back to Market Overtime. We've heard the investor perspective on the recent rate cut, but Jerome Powell's challenge isn't just about market reaction. It's about credibility, independence, and how far the Fed is willing to go in the months ahead. For that perspective and more, we're joined by Danielle DiMartino Booth, CEO of QI Research and a former member of the Dallas Fed. It's great to see you. I'm so glad you are with us. Now, there have been times that you've been critical of some of the Fed's moves. What was your initial reaction to this round?
So I was, I have been advocating for a 50 basis point rate cut in September. I'll just put that right out there. But I was, at the risk of sounding condescending, I was pretty proud of the Federal Open Market Committee. I think that they made a real stand for independence by presenting a unified front. I really do.
How did they do that?
Well, we knew that there was a large disparity of opinions. Kansas City Fed, St. Louis Fed, Schmid, Musalem, they have both been much more hawkish about inflation than most other members on the committee. You can kind of pick them out on the dot plot. Michelle Bowman, Christopher Waller, they have been advocating for the Fed to be more aggressive in its policy rating easing, and yet they all came together and stood behind Chair Powell.
They did, with the 11-1 vote
Yes.
there, and the dissenter being Stephen Myron, voting for the 50 basis points, which was, we knew that was coming pretty much. When you think about, so you are an advocate of rate cuts, and why?
Well, I do think that we've seen the economy slow through the prism of the labor market. And it's no longer just a matter of, wow, there were 911,000 revisions to the year ended March the 31st, and investors are like, who cares? That happened yesteryear, and it's, I care about what's happening right now. In real time, we're seeing large enough revisions that now we know that there were actual job losses in June. And it's just a little while after that. So on September the 5th, we found out that job losses commenced in the month of June, that the private sector has not created, outside of healthcare and education, the private sector hasn't created a single job since April. So I think that the evidence is ample that it's supporting the Fed taking a more aggressive easing stance despite inflation. And I think that Christopher Waller would agree with me, as would Michelle Bowman. But again, yesterday they disagreed.
And by doing that, there was the question about, who's sort of vying and jockeying to become the next chair of the Federal Reserve.
Right.
And Stephen Myron, by going with the 50, really showed his colors to the President Trump, and that he wants to get that spot. Christopher Waller, some people thought maybe he might jump on board on the 50. So they showed the unified front. Tell me about the Fed independence and where the Fed is heading in the next 6 months. Are we worried about Fed independence?
We may be. It really will come down to what the Supreme Court has to say about Lisa Cook and whether or not President Trump has the opportunity to appoint one or two members to the Federal Reserve. But I think markets are a lot less concerned about Fed independence than they were just a few days ago, because they saw the respect for the institution, despite the disparate views on where the economy is headed. They saw everybody stand up for Fed independence and say it's more important in the moment to make this stand than it is necessarily to dissent or not to dissent. Again, we could have had two dissents yesterday for two individuals in favor of no rate cut.
Right. Yeah, I saw that. So at this point now, you have 7 who think nothing more should happen. One who's actually leaning towards a hike, right?
Yep.
In the last meeting, Michelle Bowman and Christopher Waller were the two dissenters when the Fed paused and did not cut, and they wanted 25 basis points. Do you see maybe they made their point, right?
They certainly
this
did.
round. There's still 2 more meetings.
There are.
And so will everybody go rogue and say what they really think? Do you expect more dissenters and less unanimous or unanimity
That's a hard word,
it's
isn't
a hard
it?
word,
Yeah.
To say. But you know what I'm trying
Yes,
to say.
of course,
because they
of
made the
course.
point. And now let me tell you what I really think in the next couple of meetings. Do you expect something different in the next meeting or 2?
Well, we do have more data coming down the pipeline. So we've just had the initial jobless claims reported for the survey week that the Bureau of Labor Statistics is going to use for the September non-farm payrolls. That was a surprise to the downside. In fact, the largest decline in 4 years in initial jobless claims. So we will see if the job market continues to deteriorate. We know from following Google Trends that individuals searching for unemployment benefits, that remains at a very, very high level. So certainly not reflected in the data. But we will have to see. Job openings are declining after a seasonal spurt over the summer. The news is not improving on the labor front. But we'll see. We'll see how strong inflation is.
So what do you think Stephen Myron's role could be in the next few months until January when his time ends? And, the Fed chair, of course, that Powell's ends in May of 2026. Between now and January, could he have the ear of the Federal Open Market Committee? Could he explain why he thinks there should be more cuts this year, more 50 and 75 basis points and into next year? Could he switch some people over to his side? Or what do you think his role is?
So, again, I think yesterday the odds decreased appreciably that he's going to have influence on other members of the Federal Open Market Committee. I think that was pretty apparent, especially because the dot on the dot plot was below the 3% line, meaning he's obviously, it's judging by the dot plot, he's an it's my way or the highway kind of an individual. And also from the perspective of a Federal Reserve official, he hasn't given up his day job in the administration. He's just stopped the paycheck from coming for 4 months, but he's not technically left the administration. So I think his ability to garner credibility is not where it needs to be in order for him to exert influence over other members of the committee.
And we'll see if that sticks. It's hard to say because this is the early going. He really just showed up a day ago, right?
He did. They started the Fed meeting at 10:30 instead of 9.
When it's the new kid in the class or in the school, do they really sit at the cool table? No,
of course.
They really don't. I wonder if there is a way for him to sort of infiltrate and work some magic in his own way. Maybe not. We saw Fed independence really on display.
And we won't have to wait long,
meeting.
will we? Because Fed officials, as we know, they come right out of the gate as soon as blackout ends. They're all over the media.
Yes.
Everybody will be at their own, pick your choice of 12 podiums, 17 podiums.
True.
They'll all be out in force. And I think we'll have a much better idea for their thinking. I haven't been excited for the release of Federal Open Market Committee meeting minutes in years. And yet, I'm like, let's go October the 8th, because it'll be interesting to see how many times in the minutes it says one member, one member, one member.
Right. Oh, that's very interesting.
Because usually it says several.
Oh, put that on your calendar, folks.
Yeah.
When we think about the political pressures, first of all, I think if you go way back in time, presidents prefer to have a lower rate environment.
Of course.
They all sort of vie for cut rates, right? And the easy money. But there's legal issues that are coming into play here. There's the placement of Stephen Myron. You may have a second person put in place if Lisa Cook is out. What do you think about what happens legally? Or are there challenges or changes that happen with the political pressure in the next 6 months? Is there any way to sort of surmise or guess or even sort of, have a prophecy of what could happen?
So I think that today has probably been a disappointing one for President Trump. And I'm kind of surprised that the betting markets have only reduced Christopher Waller's shot of becoming chair from 30% to 22%. That was Polymarket overnight. So he's still in the running to be named chair, and we have to be mindful that Secretary of the Treasury Scott Bessent is definitely in favor of Fed independence. In fact, there's a little bit of tension right now between the Treasury Department and the administration, because Bessent is advocating for a total of 150 basis points, 1.5 percentage points of rate cuts. The president wants double that.
Right.
So we'll see how much sway Bessent has over who is chosen. But it sounds like if Bessent is going to get his way, that Fed independence is not going to be compromised.
And everybody respects Scott Bessent very much. I think there was definitely a feeling that he was a good choice in his role. Now he was even tossed up as the possibility for the future chair, but that seems to be off the table now.
Yeah.
I do want to get to your economic views and what's been going on here, but do you have a guess of who is the head of the Federal Reserve? Who's going to be the next chair? I mean, if you had to guess, maybe first place, second place choice, runner-up.
So 24 hours ago, I would have said Christopher Waller, slam dunk. I think the idea of somebody like a Rick Reeder from BlackRock is intriguing. He met with Bessent for 2 hours just a few days ago. I would certainly be an advocate for somebody who understood the financial markets, understood the banking system, understood the non-banking system, understands the economy. I would certainly be in favor of somebody like that. It would be unusual. And bless his heart, he'd have to sell all of his BlackRock holdings when the market's at all-time highs. But right now, I still think most of the money is going to be on Christopher Waller.
Interesting. Okay, thank you for that. We'll have to wait and see. And look, if it's not, it's okay. And we're just having a little fun here. But tell me about your thoughts on the economy. Are you more worried about the jobs picture or the inflation picture? Because then I'm going to ask you, are we heading to a recession at some point with low rates and all that? But let's start with the basics, the mandate, the jobs, and price stability.
So the longer-term revisions that have been reported have indeed shown that job losses began in the second quarter of 2024. So we know that recessions begin before job losses, because unemployment is a lagging indicator. So we know that the economy was at least in recession last year. And again, real-time data is telling us that even if the economy possibly did come out of recession around all of the euphoria surrounding the presidential election, that current data that we're looking at right now shows us that the U.S. economy is falling back into recession based purely through the lens of the labor market. What's interesting about this tension between inflation, the two mandates between inflation and employment, really was reflected in the retail sales report. That was the largest seasonal adjustment for any August in the history of the country. So without the seasonal adjustment, I promise I'm telling you this for a reason, without the seasonal adjustment, retail sales would have been negative for the month. We're coming into a very strong seasonal season for inflation. So there is the distinct possibility that we actually have upside to upcoming inflation readings because of seasonality and because the Bureau of Labor Statistics has the latitude that it does with the data, that we see some outsized inflation prints to the upside that makes Fed members more hawkish. Remember, Powell said yesterday that this was a risk management move. This was an insurance cut, meaning if we see inflation becoming problematic again, we could go right back to being on hold.
It was in 21 and 22 that we had the same sort of picture, right? The Fed was cutting and inflation was moving higher. And the Fed kept cutting and inflation kept moving higher. And there are some people who believe that is exactly the Fed's playbook between now and mid next year. So less worried about that they'll just keep cutting anyway, that the rate cycle for cutting has begun. And then the question then becomes, do you end up in some sort of recessionary environment after? What do you say?
Well, I mean, it's possible, but I think what you're really asking is, did the job losses that began in June stop? And the answer is, I don't know. So we don't know what the future real-time revisions are going to look like. It's apparent that you don't ever have job losses without the United States being in recession. I'll just repeat that. But the question is, what do then rate cuts accomplish? And are they going to be enough to re-engage the private sector to where they want to start going on a hiring binge again? Will the big, beautiful bill make a difference next year? Will that incentivize companies to invest more? I hope. I hope that that's the case, because we certainly, given the private sector outside of education and healthcare, we all need to send our kids to school, we all go to the doctor. So we call them recession-proof industries, but outside of that, we haven't seen, again, job one created since April.
Do you think the Fed has succeeded in part or failed on both, or in part on labor and inflation thus far?
So I think the Fed has done a reasonably good job bringing inflation back down. Whether it gets inflation all the way to its 2% target in a swift manner is, they don't think so. They increased their inflation projections for 2026 in the dot plot yesterday. Will there be certain areas of inflation that are stickier than others? Yes. Does it take an average of 6 quarters, according to Fannie Mae, for us to see? Right now we've got home prices falling in 80% of major U.S. metros, according to Redfin. When will we see that show up in the CPI as a drag? Or will tariffs in the short term push inflation higher? It's hard to say. The Fed has failed on its employment mandate. I think that that's apparent.
And it's interesting because you talk about recession for employment, but not necessarily being in the economy. For example, even their projections for GDP are higher.
Yes, their projections for
right?
GDP
so
are higher.
We're not going to see two negative consecutive quarters, right now of negative GDP. I mean, that's not necessarily in the cards right now. However, wait, let me just say,
sure.
However, we have had rolling recessions. I mean, we saw it in housing, and we saw it in a different sector, right? And it was sort of going around. It just wasn't all at the same time. Maybe we see something like that.
Well, I mean, what's important to consider is that the revisions that are made to the jobless numbers then move backwards through the GDP data. So until you know that instead of job gains you had job losses, you can't back the income out of GDP. So GDP, it was revised down 5 times for 5 quarters in 2001, for 5 quarters in 2008, for that first quarter of each year, before we knew that there was actually a negative sign in front of it. So that's going to take some time to play out.
Yeah. Well, that makes sense too. I mean, because sometimes, hindsight's 20/20, right? And that's the big picture.
But most Americans, and I think that's one thing you have not asked me, is where do most Americans see the U.S. economy? 65% of Americans foresee in the next 6 months the unemployment rate rising, according to the University of Michigan. The majority of Americans think we're in recession.
Well, that's what I was getting to, because what I was going to say is that you and I have had many conversations over the many years. And over those times, you said households should save up some cash. And, there have been surveys. Some people don't have $400 for an emergency, right?
They're devastating.
All those kinds
of course.
Sort of terrible stats that we don't like to really think about, but it's so true. Which brings me to the point that you're never really bullish on the economy, or on things in general, because you get these stats of what real America is feeling. So where are we now?
Well, we're certainly unhappier than we've been in a long time. And this is a product of the misery index. Americans feel that prices are still too high. They're still paying more for groceries than they were 5 years ago. And we've had more than 1.4 million full-time jobs lost since January. I dare say a lot of Americans would prefer to have a full-time paycheck instead of the part-time paycheck that they're collecting. So there are reasons that individuals are so critical of quantitative easing and the way that monetary policy has been conducted in the past few years. And in economic speak, it's because when you manipulate the economy to too great of an extent, it can't find escape velocity of its own volition. And we have to let the private sector actually exist and function. Or the Fed's just going to stand in the way, and companies are going to remain very reluctant to plan for capital expenditures or to hire people. We have to get over that hump. And corporate America itself has to be convinced that they can't just throw all their money at AI and hope that fixes things and cuts enough costs so that they can keep their bonuses up.
Right, and many people, while more have been investing, many people are not even invested in the stock market.
That's correct.
At all. The final question, I guess, would be, how would you vote at the next meeting? What would you suggest to the committee that they should vote?
So our official call at QA Research is that we're going to see 50 basis points in October, especially if we continue to see deterioration in the labor market. I think it is.
And that will help the labor market in particular. You're
I think
less
it'll be more
worried
of a
about
signaling
inflation.
device than anything
Right.
else, and just to say we're with you, not against you, and we want to help where we can. The irony here is we need home prices to keep falling to become affordable for the next generation of buyers. And that actually is accomplished by the Fed maintaining very high rates. So there's an irony here, but that's what happens when the Fed goes and buys 40% of the mortgage market, which it did.
Danielle DiMartino Booth, it's always wonderful to chat with you, particularly around these Fed meetings, and really, pick your brain, having been part of the Dallas Fed yourself, a former member of the Dallas Fed. Thank you, Danielle DiMartino Booth. Thank you.
Thank you, Nicole.
And our thanks to both Danielle DiMartino Booth and Dan Niles for their insights. And thank you, friends, for joining us right here on Schwab Network. I'm Nicole Petallides. Remember to watch new episodes of Market Overtime every week and on our Schwab Network YouTube page. I'll see you next time.